Alright, good morning class. This is your instructor. Today we are going to be doing some analysis, practical example of the concepts involved with the accounting cycle. So now this is just, out of a series of lectures that I have been delivering in accounting cycle. These are just a few examples where you have exercise questions and they are of mild nature, and I would like that you further go study the book so that we can do problem questions. That would involve making of the balance sheet as well as the income statement. That will be the next lecture. Okay. So now let's just look at the principles, and this is just situational evaluation of some of the choices that have been put in front of us. For this is just to recognize whether some of these could be accounting principles, some of them could be some conventions or any kind of condition. So how to differentiate between conditionalities, accounting conditions or situations or conventions and principles. Now 3.1 says that listed as follows are 8 technical accounting terms. This is chapter 3 and pertaining all these learning objectives 3-7, 8, 9 and 10 and beginning from all these. So you can just simply see it says 3-1, 2, 3 and up to 3-10. So 8 technical accounting terms. Now technical means the things that you don't really get to hear about on a daily basis. In this chapter, so realization principle is one of them too. So now each of the following statements may describe one of these technical terms. For instance, part A says that a span of time covered by an income statement. What do you call this span of time? So you have now these 4 on either side, so there are in total 8 of the choices that are in front of you. Now span is typically, you could be very tempted to term it as a time period principle. But if you know about the principles, you will know that there is no time period principle in accounting. It's just the span of time by an income statement. So you know that it's a yearly income statement, and that will be naturally accounting period. This is going to be the choice 6th. Because accounting period is within which you have to make the income statement, balance sheet, and ledgers and trial balance, and all these financial statements are made within this 1 year period from January to December or from 1st July to 30th June of the next year. Part B says the sequence of accounting procedures used to record, classify and summarize accounting information. And the sequence is naturally, you know that we have been doing it, it's accounting cycle. Part C says the traditional accounting practice of resolving uncertainty by choosing the solution that leads to the lowest amount of income being recognized. Alright, so it generally says that there's a practice going on in which you recognize the lowest amount of income that is actually being undergoing the process of evaluation. So you might consider that you would be getting $1,000 after selling off the inventory, but there is a chance that some people would not be paying up all the money. So there's a chance that you could get $900 instead of $1,000. So you will be recognizing $900 instead of the $1,000. And this principle is generally the conservatism principle. So I'll just write it down. And since it is not mentioned here, you can't write anything, so you just write with a nil. Okay. So this is conservatism. And you can also Google this. Okay, so I'm just writing it separately. So you can just see this conservatism principle. There you would go into the mode of conserving the reporting of income so that you don't overstate what you're saying as being recognized as the as the revenue of the year. And so that in case if you don't get 1,000 and you get 900, it's always better to report that lower amount. But if you get 1,000, then it will only be upgraded, and it is good for the business. Then eventually you will be having a surplus or show it as a surplus. So this is not mentioned here. You just give it a nil. Now then, there is a D part says an increase in owner's equity resulting from profitable operations. So now we know the counting equation of assets equal to liabilities plus owner's equity. You know that, or just equity simply you know that if there's equity, then there's also net income in this, or you can just say that it is retained earnings. Retained earnings, we've been discussing this previously, amply have discussed this, that whatever you retain from the profits and from the money that you injected initially. So these are the retained earnings, and liabilities are just the loans. So if there is an increase in owner's equity, that could be partially because you have been earning more. So then that would be the net income, as you can see. This is this part. Then there is the underlying accounting principle that determines when revenue should be recorded in the accounting records. As I already stated, that this is just done yearly along with the expenses. And we have the matching principle as well as the realization principle, okay? So when revenue should be recorded in the accounting records could be, for both, but it is the realization principle generally because revenue has to be recognized when it is earned. So you can't really, like I mentioned that in the previous lecture, that you may get money for the services that you have not rendered as yet. So you can't recognize that because it has not been realized as yet. So realizing means that you have rendered the services, okay? So now we're just going to be saying that this is the realization principle. And again, this is the F part, which says that the type of entry which is used to decrease an asset or increase liability or owner's equity account. So now what they're saying is you need to identify what kind of entry it is. So in this case, this is the credit entry because we've not been given any other entry, and we just have the credit entry. Now the type of entry is used to decrease an asset or increase a liability. So if your liability is increasing, naturally it's going to be on the credit side. And if you're crediting something, if your asset is credited, it means that it is reduced. So it's just a credit entry. Now the underlying accounting principle of offsetting revenue earned during an accounting period with expenses. So when revenue and expenses are offset, it means, the word offset means that as much revenue was earned, according to as much expense has been incurred accordingly, so that the revenue is equivalent to the expenses that have been incurred or slightly more because you have to also earn profit. So revenue matching principle, that would be the matching because you match the principle, you match the revenue with the expenses. So you earn the expense, the revenue in 1 year, and then you're going to be incurring further expenses, and then you get profit out of the profitability operations. Or profitability is determined through the excess of revenue over the expenses. So this is basically the matching principle. And now we have the cost of the goods and services used in the process of generating revenue. Okay, now this, when you have costs used up, means it has been consumed. So I told you that when you have consumption of assets, it's termed as expenses, and the costs are also as sort of like expenses. If it is not directly related with costs, they are indirect expenses. Whatever is related to costs, and there are direct expenses, and they're known as direct costs. So, because since had it been included in the cost, it could have been expenditure also. But usually expenditure, this term is used for purchasing of assets, and the cost is usually with the dispensing of cash for the inventory that you are going to sell and the goods and services that you're going to sell in that one accounting period. So it is going to generate revenue for you. So if it generates revenue and you consume the entire amount for generating revenue for that particular period, because it's not going to be giving you benefit in the successive accounting periods. Only assets give you benefit in the successive accounting period. So if you reap the benefit in one accounting period by selling the goods and services, that will be reported in the income statement against the revenue you earn from these as cost of goods sold and other expenses, okay? So this is just expenses. And now we're moving on to the next part, which I guess is 3-4. Okay, now this is 3-3 first of all. And then 3.4 is also preparation of trial balance. Let's just also look at this, but 3.3 is very important. Okay, now they have given us ledgers, okay? So now they have not balanced the ledgers, but you can balance the ledgers if you have the balances with you, okay? So you can just simply find out the balances first of all. As you can see that there are no balances here for the cash, but you can find out the balance through 144,000 by 40,320 less 14,400 less 1680, and you get about 87,600. So now this is 87,600 is the balance, okay? So now you have, this is the balance that you get, okay? Now this is just one of the examples. What they're actually asking is the relationship between journal and ledger account. So first of all, you're going to be making entries pertaining to this, right? So how do you make the entries? So now you have Evanston Insurance Company. You have to prepare a journal entry including a written explanation of each transaction. So first of all, you have to look at the time period. So this was on November 1st. So you have any other to offset the debit and cash. As you can see that there is a debit in cash. So how do you offset this debit? Okay, now you have November 1 capital stock, right? So now as you can see that this is debited with cash. Okay, so this will be cash 144,000 to capital stock as 144,000. Okay, now this is one entry for November 1st. Then comes November 8th. Now cash is credited at 40. What else happened on November 8th? You also had notes payable and you had building. So that means when your, okay, so you also had land, right? So now the entry that you're going to have is land as 84,000, building as 70,320, to cash as 4320, and also notes payable as 114,000. But you also have to make sure that both these sides balance together, okay? So you have to add these up, 70, 80, 90, so it's just one, so it's just 15, 154, 320, and you also have to see that this is 154, 320. They are balanced at the moment, okay? Because the debit side is equal to the credit side. So that means on November 8th, you did this entry. And this was, the date has to remain the same. Make sure that this date is the same. And then comes November 15. Okay, so now it may not be a cash entry because you have to go in a chronological order. First was November 1, then was November 8. Then you have to see before November 25, okay, there's a November 21. And there's also November 15, okay? So on November 15, there's account payable increase, 3840. And let's see if there's a debit on November 15, yes, office equipment. So naturally, it means that what you did was that you had office equipment as 3840 to accounts payable 3840 on November 15, okay? So now this is the third entry. This is the third entry. Now what about November 21? This is accounts payable was debited against what was on November 21. Okay, so this was office equipment was credited by 576. So accounts payable 576. This is dollars, by the way, to office equipment. So that means that you actually sold the office equipment and paid off the part of accounts payable, okay? Or you gave the person some equipment in exchange for whatever outstanding accounts payable was there. So now when you settle the accounts payable, you actually debited. Okay, so you're going to make the reverse entry because the liability would actually get debited when it is being reduced. Or you reduce the liability by debiting it, okay? Or it's also known as offsetting or reversal. Now, then there's November, after this November 15 was done. Then this is November 21. And then there's November 25. Okay, so now you have cash, November 25. You have notes payable as decreasing, and you have cash as decreasing. So you have notes payable debited as 14,400, and you have cash as 14,400 on November 25. So it basically means that you have settled this notes payable with cash, alright? Then you have November 30th. Now, interesting is that this is vehicles. You purchase the vehicles by giving this cash, and what else do you have? Okay, accounts payable was, no, not accounts payable, this is, okay, what else do we have? Because this account has to be balanced. So we have to see what else is on November 30th. Okay, this entry, notes payable was credit, okay? So now the last entry, which is November 30th, you have notes payable as 9,600, and you have the vehicles as 11,280, and you also have cash as 1,680. So now, when you make the trial balance, you have to see all the credit and debit sides. So for trial balance, you know that how much cash you had in hand. So now, as I told you that the balance was approximately 87 something, you find out the balances of each. Okay, so now these are already balanced. So now for trial balance, you have the cash, okay, then you have the land or the building, whatever this is, land, building, then you have office equipment, okay, and you have the vehicles. So these are the assets first of all. So this is going to be current asset, then you have fixed assets, then you have liabilities, okay. Now liabilities are the notes payable. How many were, you have to find out the balances between them. The remaining balances would be as many, just from the heavier side you subtract the lighter side, okay. So this was the main side. For notes payable is the credit side. So now for instance, what would be the notes payable is going to be 114,000 plus 9,600 less 14,400, and you are 109,200. So now your notes payable would be 109,200, okay. Similarly, cash was, what was the cash? It's 144,000 less 4320 less 14,400 less 1680, and you get about 87,600. But you have to make sure that whatever entries that you have done, this has to be with this has to be in consonance with the figure that you took out from subtracting the debit, the credit side from the debit side. So when you take out the balance, if there are more than two entries or more than one entry, you would actually balance by subtracting either side and taking out what was the remaining, carried down in this case. So now this was carried down as 87,600, and the balance was 144,000 on either side, okay. So 144,000 on either side, and that will be the brought forward for the next time period. It's going to be 87,600. This is the remaining cash that you have. Now again, land would be written as such, which is actually 84,000, because there are no further entries of land, and building is 7320. Okay, so now then there is also accounts payable. Now accounts payable is just one entry, and you know that this is the debit 3840. Okay, so now there's also 576 is the debit and 3840 is credit. So you can just simply find out by subtracting but sometimes you're not that fortunate to actually find out the balances directly, because you're supposed to just make the journal entry, then you make the ledgers yourself. But you have to find out by looking at what was accounts payable initially. This was 3840. Then you have the debit entry as well, and you subtract these, and you get 3246. Okay, so 3246, and notes payable was accordingly. You can just find out what was the notes payable. Okay, I wrote this amount. I just have to do that again. And plus 9,600 less 14,400. So you have about 109,200. And now the vehicles. What was the vehicle? Counts. 11,280. Office equipment was, you can just simply find out 3840 less 576, and you have about 3264. And then I think this is just complete one, but you also have this liabilities plus owner's equity. So it's assets is equal to liabilities plus owner's equity. So, or equity. In this case, so equity, you have capital stock of 144,000. So cap is 144,000. So now here is your TV. Okay, so this is just trial balance for the period of, like, for instance, 2020 or 2019, because for 2020 you have to wait till December. And you're done pretty much with this question. But you need to look at these, in a broader perspective, that you might have to actually pay the trial balance instead of they being given to you. And this was actually 3.4 part of 3.3. Okay, so now this is 3.3, 3.4. And now 3.2 is actually your, just you have to understand that it says that you just have to assume that you own a car that drives about 50,000 miles each year. Since we in this Asian region, we have kilometers, and you know that for 1 liter, we have approximately 16.5 kilometers. Okay, so you can just use, instead of the miles, because for America and they usually have miles and gallon concept. Okay, so they might actually have maybe for 1 gallon they might be traveling 30 miles or something like that. Anyway, so you can just simply find out what are the costs that are associated with the vehicle, and you can answer this question whether, if you already have a full gas tank and your boss tells you to drive 100 miles, but you already have that, so would you be asking him to give you some kind of money to reimburse for the expenses that you never incurred because you already have the gas tank filled? The answer is that obviously you have some costs because you initially paid for filling the tank, so as much as you could maybe have paid, right, maybe 4,000, 5,000 rupees, or in dollar terms maybe you paid about $1,000. Similarly, because you were maybe traveling 100 kilometers or you did maybe 1,000 kilometers, you don't know, as he has given you a lot of work in the whole year to do. So even if initially you had some, you're still going to be including that filled tank as the initial cost incurred. Even if you did not fill the tank, the fuel was filled initially by you before the task was given to you. So that means that you have to get the reimbursement for that as well, even if you did not go after he was giving you the order, right? So that means you have to include the depreciation cost, the wear and tear, the license, the registration, and the insurance costs. All these will add up, and you find out the total cost and you divide by the number of kilometers that the car is doing, so you'll get the cost per kilometer. And then you can multiply it with the number of kilometers that the boss will tell you to actually go. And I'm going to be ending my lecture here. Thank you so much. And I hope that we can further go into finding out what the balance sheet concept is. Let me just tell you that this is this after this question 3.5. They've given you a question of assets, liabilities. Usually this is the concept of balance sheet, that you have assets, you have liabilities, and you have owner's equity in a statement form. They told you to determine what is the total liabilities. So now these are unknown quantities, so you know that asset is equal to liabilities plus owner's equity. So now if you don't have this value, naturally you're going to subtract from 87, you subtract this value, and you get the owner's equity. Similarly, for assets as 87.3 million, your owner's equity is 23, you subtract this from this, and you get this value, okay? So now part A and B would be complete. And third is retained earnings was reported. So now the value for retained earnings is, let me tell you the equation for retained earnings, and you can find out the value as well. You can switch to the word. So I need to tell you that how do you do this part. It's just that you have the initial value as opening retained earnings plus net income less dividends. Okay, so these are the have a different notation for this. These are dividends, okay? And they give you closing retained earnings, okay? So if you have value for this given, you have the value for the during the period. So I think this was opening retained earnings at 65 point something $4 billion. As for the question, I don't know what the net income was. You are supposed to find this value, okay? They have given you the dividends. This is X, okay? This is your X. So if you have been given this value, and you have been given, I think, 60 point something billion. This value and the dividends are also something 5 or 6 billion, okay? Just check them out. You can just find out by, adding it here, and subtracting this from this, and you just get this value, okay? So this is left hand side, this is right hand side. Just put it on one side of the equation, you find out the value of X. When you have opening retained earnings plus net income less dividend is equal to closing retained earnings. So here I will be ending my lecture. You have done first 5 questions of the exercise, and this is the C.5, okay? Then you have the concept of a balance sheet, and then we can do further question. Then you look at the demonstration problem in the previous lecture. Thank you so much, class.